In 1935, a young woman named Grace Groner walked into her office in Chicago. She was a secretary, and she made a modest salary. She lived in a small house, bought her clothes at a rummage sales, and never owned a car. On her way home one day, she did something that seemed utterly unremarkable. She bought 3 shares of her employer's stock, Abbott Laboratories. The cost $180. Probably a lot of money for her. In 2010, Grace Groner passed away. The lawyers opened her estate and they found something that made the headlines around the world. Those 3 shares purchased for $180 has turned into $7.2 million. Grace Groner didn't have an MBA. She didn't watch CNBC. She didn't trade options or time the market. No. She just bought great companies and automatically reinvested the dividends. And absolutely she did nothing else for 75 years. Probably she worked hard. Today we're going to talk about these kind of stocks Grace Groner would buy. The kind you can hold forever. The kind that pay you just for owning them. But before we go to the list, we need to understand something. Because there are 2 ways to think about the dividend stocks. We have the dividend growth versus the high yield. The dividend growth is for people who want their income grow over time. So you start with a smaller yield, but the company raises its dividend every year. So after 20 years, your yield on cost, that is what you earned based on what you have paid, can be enormous. Then we have the high yield. It's for people who need just income right now. The retirees or people they live off their portfolio. You got a bigger check today, but the company might not raise its dividend much. There's also a warning because sometimes the yield is a sign that it's maybe tricky. Today we will have both of the stocks in the list. But most of them are always the dividend growers. The top 7 dividend stocks you can hold forever. Let's go to it. And these aren't actually in a particular order, because the best, it depends on you. But each of these companies has really something very special. A history of paying and raising dividends through wars, recession, and market crashes. So, stock number 1, the aristocrat of them all, Coca-Cola, the drink that conquered the world. Warren Buffett's Berkshire Hathaway, he owns 400 million shares of Coca-Cola. They bought the most of them in the late 80s for about 1.3 billion. And today, those shares pay Berkshire 736 million in dividends every single year. It means Buffett's yields on cost, so what he earns based on what is paid, is approaching 90%. He's getting his entire original investment back every 18 months in cash without selling a single share. That's the magic of dividend growth. You buy it once, you hold it forever. And eventually it pays you more than you paid for it. And the risk? Coca-Cola payout ratio is high. It's around 145% of earnings. That means you're paying out more than they earn. But that's because earnings fluctuate. The cash flow is still very strong and the brand is irreplaceable. Stock number 2, the secretarial wealth builder. Abbott Laboratories, the company Grace Groner worked for. The company that turned $180 into $7.2 million for these hard-working women. Abbott is a healthcare giant. They make everything from the baby formula to heart devices to blood tests. And they have been paying dividends since 1924. Abbott split into 2 companies in 2013. You have Abbott and AbbVie. If you owned Abbott before the split, you got shares of both, and both companies have continued raising the dividends. So that means one investment became two income streams. And that's actually the power of owning companies that grow and they adapt. And the risk? Healthcare is always under political pressure. But people get sick. And in every economy, stock number 3, the household name you use every day, Procter & Gamble. If you walk now through your house, you will probably have a dozen of Procter & Gamble products. P&G has raised in dividends for 69 straight years. That means if your grandfather bought it in the year of Eisenhower was president, he's gotten and raised every single year since. Actually, Procter & Gamble doesn't sell products. No, they sell necessities. And when the economy crashes, people still brush their teeth. And they still wash their clothes. And they still need diapers, to call some. That's why Procter & Gamble earnings are so stable. And the risk? Growth is slow, of course. This is not a stock that doubles overnight. It's a stock that compounds quietly for decades. Stock number 4, the railroad that built America, the Union Pacific. The railroad that connects the West Coast to the rest of America. And railroads are one of the best businesses in the world. They own the tracks. Nobody can build new ones. And they move everything. The cars, the grains, the chemicals, the coal, consumer goods. Railroads have just massive pricing power. And when inflation rises, they raise prices. Their costs don't rise that fast, so they make them inflation fighters. Union Pacific has raised its dividends for over a decade straight. And because they are in a duopoly with the BNSF, they have pricing power that most of the companies can only dream of. And the risk? Maybe the economy. When manufacturing slows, of course the railroads will slow as well. But over 50 years, be honest, America moved the goods and the railroads moved them. Stock number 5, the landlord of America, Realty Income. They call themselves the monthly dividend company. Realty Income is a REIT, a real estate investment trust. They own thousands of properties across America, mostly single-tenant retails. You know them, the Walgreens, the FedEx, the Dollar General, 7-Eleven, and they collect rent every month. And because they are REIT, they are required by the law to pay out 90% of their taxable income as dividends. And that's why the yield is so high and why they pay monthly. For retirees who want to have a steady paycheck, monthly dividends, they are huge. So you got your rent check, you got your Social Security and your Realty Income dividend, all in the same month. And the risk may be only a short-term interest rates. When the rates rise, the rates often fall because of the investor can get safe everywhere by the treasuries. But if you hold forever, the rents keep rising, which means your dividend grows over time. So those annual rent increases built into the leases compound, into real income, growth for you. Number 6, the industrial giant, Caterpillar. When the world builds, Cat machines dig the dirt. Caterpillar is the largest construction and mining equipment company in the world. Their machines are really everywhere, from the suburban housing development to the giant copper mines in Chile. Caterpillar's real moat isn't actually the machines, it's the dealer network. There are Cat dealers in every corner of the world. The stock parts. They provide service. If you own a Cat machine, you can just switch it to another brand. So you have to rebuild your whole entire supply chain. And that is the aftermarket business. Parts and services. It's incredibly profitable and it keeps cash flowing even when the machine sales slow down. Then the risk, maybe the cyclical. When the global economy slows, of course the construction slows down also. But over 30 years, the world keeps building. And then the last one, stock number 7, the Canadian survivor, the Bank of Montreal, the oldest dividend payer in North America. BMO has paid a dividend every year since 1829. Let that sink in. 1829. Andrew Jackson was a president. The bicycle hadn't been invented yet. And the first railroad in America was 2 years away. Can you imagine that? And the Bank of Montreal was already sending checks to the shareholders. Canadian banks are different from the American banks. They are more concentrated. The 6 big banks control over 80% of the market. So that means less competition, more stability, and fewer bank failures. During the 2008 financial crisis, while American banks were collapsing, the Canadian banks barely blinked. BMO never cut its dividend. And the risk? Yeah, banking is risky always, but in 197 years of dividends suggest they know what they are doing. These are 7 good dividend stocks in different sectors as well. But why are they good? And what can we learn from them? I always want to learn something. So they look at the current yield. But the real magic is the yield on cost. Let me explain that for you. Imagine you buy a stock at 3% yield. They raise their dividend 8% every year. In 10 years, your yield cost is not 3% anymore. It raised till 6.5% on the money you invested a decade ago. In 20 years, it's over 14%, and in 30 years, it's over 30%. And that's what happened to Grace Groner, and that's what also happened to Warren Buffett. So they didn't buy the high yield stocks. They just bought the growing yields and held forever. Now compare that with a high yield stock that starts at 6% but never grows. In 20 years, your yield on cost is still 6%. So the growing stock hasn't blown the past. A study from the Breckenridge Capital showed that a portfolio with a 1.8% yield but 12% annual dividend growth beat a portfolio with a 2.7 yield and 6.6% growth by year 10 already. By year 30, it's growing the portfolios triple. So the high yield portfolios will lose. In this part, it's maybe difficult to understand, but maybe look at it this way. The yield on cost is your annual dividend divided by what you have paid. The current yield is your annual dividend divided by the current stock price. And that's why dividend growth is so powerful for the long-term investors. And once you buy, your cost never changes, but your income keeps growing. Now, let's say you want to make your own portfolio. Try to think about what you have learned and do first some research. And then maybe think in buckets. So I will help you with this. Make maybe 3 or 4 buckets. We have bucket 1, the core. For example, Coca-Cola. These are your sleep well at night stocks. Low volatility and global brands, decades of increases. Bucket number 2, the growers. Caterpillar or Union Pacific. Lower yields today, but the double-digit dividend growth. These are for the investors with time. Bucket number 3, the income. Think about the Bank of Montreal. Higher yields now, but slower growth. These are for the retirees or anyone who just need cash today. I need to temper a little bit your excitement, or at least a quick insight of the risks. Because with dividends, they can fool you also easily. So here are 4 warnings. Warning number 1. A high yield can be a trap. When a yield looks too good to be true, like 8, 10, 12%, it usually is. The stock price has often fallen because the dividend is about to cut. Warning number 2. Dividends aren't guaranteed. Companies can and do cut them. In 2020, during the COVID, even some aristocrats cut or suspended dividends. Warning number 3. Taxes matters. In a taxable account, dividends are taxed income. In a retirement account, they are tax deferred. So where you hold them, it matters. Also look in your own country. Warning number 4, diversify. Don't put everything in one stock. Not even Coca-Cola and not even Grace Groner. She had all her money in Abbott. It worked, but it might not for you. In 1935, a secretary bought $180 worth of stock and forgot about it. By the time she died, she was a multimillionaire. She didn't trade, she didn't time the market, she just owned a great company and let them pay her. The 7 stocks today on this list aren't magic. They are also not guaranteed, but they share something with the Grace Groner Abbott shares. They've been paying and raising dividends for decades, through war and to peace. I hope you like the 7 stocks and you can check them all. They are very, very good. But I also hope that you learned something today. And if so, please subscribe. Because dividends are not guaranteed, but I can guarantee you that you can see much more of these kind of videos. Have a nice day, God bless you, and see you next time.